Welcome everyone to Jim Dalton's presentation for Intensive Preparation Part 1. It's Monday, January 12th, 2015. It's currently 4:16 p.m. Eastern. We'll go till about 5:30. And for those who may not be aware, we have another webinar, Intensive Preparation Part 2, on Wednesday, same time. You can register at our website. So Jim and I want to thank everyone for being here. It's great to see you all. And this will be recorded. It's being recorded as we speak. We'll have it up not until later tonight, probably about 10 o'clock Eastern. This webinar recording will be loaded. And with that, I will introduce Jim Dalton.
Thank you, partner. The Part 1 is going to be more personal and talking about our behavior and things like that. Part 2 will be much more mechanical and work more with references and actual trading on when we get to Wednesday. The mindset of a successful trader. Truly, a successful trader is truly passionate about trading. They have a constant study, including market understanding, which is heavily oriented towards understanding the behavioral characteristics of the other market participants. This includes, and I've listed some of them, momentum philosophy. There's a lot of momentum trading in the market, and you need to really understand and appreciate how they trade. The example that I use so often when we're talking about momentum trading is I use an example of a racetrack where you don't have to bet on the horse until it's just a couple foot from the finish line. You can bet anytime. Well, what would happen if you bet on the horse when it was just a couple of yards from the finish line? All the money would go to the winning horse. There'd be no real payoff in the pool because the way a betting pool works, it's dependent upon how much is bet on each horse. And so if the betting could take place until the final couple of seconds, you may have the winning horse, but there won't be any payoff for it. So momentum trading is good in most cases when it starts, but then it goes to extremes. Momentum traders, they just keep buying more and more. If the market's going up, they buy every break, and they keep buying bigger and bigger and bigger. And that's where the problem comes in. If you understand the momentum trading, there's a portion of it that is very good. And that's in the early stages, and as it starts to gain momentum in the middle of a move. The really dangerous portion is at the opposite extreme when momentum has reached an excessive portion. And we saw that when the market went down 9.9%. We saw it reach an excessive level. They got tremendously short. We saw the market come all the way back and take out new highs, and then they got it too long, and we saw recently that that momentum trading turned and came back the other way. So, but it's understanding what it is and what it isn't. Now, another thing, you hear people all the time talk about being contrarian traders, or I'm a contrarian thinker. Well, that's got its pluses and minuses also. It's fine to be a contrarian. For example, if the momentum traders have oversold and gotten the market too short, that's a great place to be a contrarian trader. However, once the market starts to move and it gets back up into the base of the rally, you want to be like everybody else at that point. Some people get in trouble because they pride themselves on always being a contrarian. That will normally not serve you very well. It's one thing to be a contrarian at the extremes. In the middle, when the rally starts or the break begins, then you want to be in the center of it. You want everybody to help lift your boat at that point in time. And then you can be a contrarian again on the other extreme. Part of the understanding of this behavioral characteristics of the people you're going to participate in. Day time frame traits. The traits of a day time frame trader are quite different than anybody else. For example, The day time frame trader looks at the overnight high, looks at the overnight low, pays a tremendous amount of attention to the opening price, mechanically looks at half back, as the market is trading throughout the day. When you see these kind of references, when you see half back and the opening being significant day time frame references, gives you a pretty good idea who is dominating the market. Once you know who's dominating the market, then you have a pretty good idea of how to trade the day. Short-term traders, that's the next time frame longer than the day time frame, they have a tremendous amount of money. They have some very large pools of capital. However, they're not interested in long-term positions. These are people that will gun the market and they'll press the shorts. They will get too long or too short themselves. They trade outside of the previous day's range, and they may go to bracket extremes or balance area lows, etc. Today we had a 2-day low. They easily broke it below that 2-day low this morning. So they have whole different characteristics about them. Let me see if I can go to today's profile just for a second and see if I can help make a little more sense out of what I'm discussing right here. And again, I don't want to go into a great detail about today's trading, but I want to give some sense of the importance of understanding these characteristics. So start off with, we had a poor low on Friday. And for those that are in the intensive, they got a report over the weekend, and one of the things that was pointed out was the poor low on Friday. What does a poor low mean? It means that was not completed, that auction to the downside wasn't completed. Are poor lows always taken out? No, they're not always taken out, but you certainly want to be alert for them to be taken out. So we had a poor low. The market opens this morning, and we trade a little bit higher, and the report I wrote this morning is be careful, there's liable to be a little bit of chop early on. Market opened and went higher, and then crude oil started to make new lows. And when crude oil started to make new lows, we've got this craziness that is set up recently, but it's understanding the market that traders believe that all they have to do, if crude's going down, then they need to sell the market. They think they see a pattern. That will not be a lasting pattern, but that's what the craziness is right now. When you look at what happened this morning, we came straight down. We easily took out that low, easily traded below the 2-day balance, went down, filled the gap. We had a gap from last Thursday. That gap was filled. So look early on, all of these single prints from the A-period high at the 2042 level all the way down to the A-period low at 2016.75. B came back and took it out a little bit. When I see all those single prints, that tells me a lot about who is in this market selling. When I look at that, I say that is the short-term time frame that we talked about a little earlier. They have a lot of money, but they're not long-term holders. They will press a market, but they're very nervous, but they will gun a market either long or short very, very quickly. I know, and this is one of the things that we'll address as we go through the intensive, when I get that craziness that takes that market straight down from the 42 level all the way down, eventually B got to the 15 level. I mean, it's 15, 16 handles. What it is. That is not what long-term money does. Investment money does not come in and butcher a market. So that gives me some idea early on that there's this craziness going on. It is very emotional. It more than likely will get the market too short because these people have a tendency to go from one extreme to the other. Then what you'll see is the market after it did that, it came all the way back. There's half back. The market stopped at half back. It never got accepted above half back. It just traded 2 ticks above half back after the big A period low. Now, what I just talked about, when it goes exactly to half back and then sells off again, that gives me more information. And that more information is that my initial assessment was correct. This is short and daytime frame trading. It is not longer-term money. If it was longer-term money, it's not going to come exactly to half back. Longer-term money has no idea where half back is. Then the market traded within basically this range for the rest of the day from half back. We had a point of control, and for those that get the chat, 20, 23, 25. That point of control did not change all day long. And we got a little long up here, we got a little short down here. We went down and rallied from being too short 3 times this afternoon. Went back up, closed here. But knowing, my point is, before I go on, is knowing who is trading the market. Knowing that it's not long-term money. If it was long-term money this morning, boy, watch out. We may have something really new going on. But making that assessment early on that it wasn't long-term money, it was short-term and daytime frame, emotional, knee-jerk trading decisions helps me tremendously not get cognitive dissonance and understand what is going on in today's market. And it actually turned out to be a very tradable market today. There were some absolutely wonderful trades in this market. And it stayed right about the point of control. The point of control never migrated. It stayed right there. All right. I'm not here to talk about today, etc., but I wanted to talk about the importance of understanding the characteristics of the people that we are trading against. Every other person out there wants to take our money. So we just talked about some of the characteristics of the short-term traders and the intermediate long-term traders. What I eliminated early this morning, that I did not have intermediate or long-term trading money. I did have short-term traders, and I did have the daytime frame, which of course will pile on. Having that information and being able to make those assessments, tremendously importance to how you're going to trade the day and to your overall success. Now, moving on, we have a reading list that you can see under resources at our site. But there are 2 books that I think you ought to read, and if you've read them, probably review prior to the start of the intensive in a week or so. One is The Power of Habit, and The Power of Habit was sent to us by a client, and an institutional client in Romania, and it turns out to be a wonderful book. And the important point is in there is you don't change an existing habit. You start a new habit. You build a new habit, but you don't change the existing habit. You build a new habit, and building that new habit is very, very important. First, you have to understand what you have to change, then you build the new habit. The other book is Thinking Fast and Slow by Daniel Kahneman. He's a Nobel laureate. It's a great book because one of the things it addresses several things in there. One of the first things that caught my attention, it helped me understand anchoring. A lot of times you'll see a high or low for the day and you'll say, well, what is that? It just it stops. For some reason the auction stops there. Now, and once they have a low or a high, it is amazing how the market gets anchored around that high or low for the remainder of the day. For example, the low today was made in B period. We saw that on the earlier chart. We got anchored. Everybody thought that was the most important point, and we never took that low out for the rest of the day. Now, some people get all up, they say, well, Jim, explain to me, why exactly was the B period, why was the low at that price? And the reason you can find in a lot of times in Thinking Fast and Slow is because that's for some reason where the market stopped this morning before it rallied, and once it stopped there, everybody decides, oh, they're anchored that that's the low for the day. So the power of habit and understanding, you build new habits. Thinking fast and slow gives you an idea about anchoring. It also addresses how we make fast decisions and how we make slow decisions. Both are necessary, but a lot of times if we're going to make an error, it's going to be in our fast thinking. So you need to understand that process. Okay. A successful trader differentiates between trading and investing. A trader is not an investor. Failure to make this distinction will lead to cognitive dissonance. For example, I get questions all the time. We may have a market that's making a trading move to the upside this morning, and somebody will ask a question and say, well, yeah, but Jim, what about, I think this market looks really poor over a long-term basis, or the economic number this morning wasn't very good. Doesn't that mean we're going lower? And those are questions for investors. They are not questions for traders. It is very important to decide that you are a trader, and we'll talk again about it later, but what is your time frame? Most of the people that we deal with are day time frame or very short-term trader. So understand that's a clear distinction, and once you get the mindset that you're a trader, you don't care about the long-term investing, you will have a much better opportunity to be successful in trading. Trading is far more dependent upon understanding the emotions and behaviors of those you are competing against. I walked through an earlier example where I showed you this big fast break this morning of 15 or 16 handles, why I thought that it was day and short-term traders, not a change in longer-term thinking. Because I got all these emails. They say, oh, Jim, is this longer-term money in the sell side? And I'm saying, I don't think so. I think we had day and short-term trading money in there. And understanding their behavior, and you saw it later on, that we traded back and forth for the remainder of the day. Understanding what was going on gave me a tremendous advantage today. Okay? An investor may be accumulating a large core position that is intended to be held for months or years. He doesn't care about the traders. Matter of fact, if a market goes down, he says, I love it, I want to buy more. He may be accumulating millions of shares. I used to run an institutional trading desk. I know how they operate, and they're totally different. Traders are concerned with right now. They operate in the present tense. I used to do a seminar series. It was on the old-fashioned tape sets called Operating in the Present Tense. And many of you who have been with us for a while know that people started sending me books from Jackson, who was the coach of the Bulls, and they had all phenomenal years in there. And they thought this was the same thing I was talking about. I didn't know what he wrote or read, but talking about getting the team prepared to operate in the present tense. As traders, we operate in the present tense. We are concerned with the emotions of the people we are competing against. We're concerned with their behaviors, and we're looking closely to see when they get a market too long or too short in the day time frame. This morning, they got the market too short. Then they got the market too long. Then they got it too short 3 more times. Understanding that they're going to do that and understanding that's more than likely what's going on gives you a tremendous edge that is really hard to overcome. But if you don't understand that, then you get caught just when they're selling the market off and getting it ultra short. You get caught and you end up on the wrong side of the market. The mindset of a successful trader is meticulous preparation. Very, very, a lot of time preparing for a market. It's like any activity. We've got the playoffs getting ready for the Super Bowl, and you take the amount of time that these teams spend on the actual field in front of the TV versus the countless hours that they spend watching game films, practicing, and everything. It's no comparison. It's meticulous preparation. And it's understanding the game plan, understanding what the other people are doing, right? We talk about, let's look at the similarity. They're always out there figuring out what's the behavior of the people that they are going to compete against. And they're trying to position themselves to take advantage of that expected behavior or if the or to stop their expected behavior. There's a tremendous amount of similarity between trading. Trading is a game, just like football. There's winners, there's losers, there's those that are better prepared than others. Patience. You got to be very patient. Markets don't get too short or too long instantaneously. It's a process, you know. And if you see a market getting too short, can you observe this process and not get too anxious? Can you resist going along with the laggards, going along when the laggards are selling, for example? Can you pull the trigger if the correct trade flies in the face of the most recent market activity? Let me go back to today's market for a second. Anybody that is preparing for the intensive, they get our chat comments. It's a one-way chat, and I put out a chat this afternoon. I don't remember the exact time, but I was looking at the point of control up here at the 2023.50 level. The market was selling off, and I said, it appears that the market is getting short in the hole. Now, what does that mean? The point of control, or the longest line leading from left to right, is the fairest price at which business was being conducted today, or the fairest price that business is being conducted any day. As traders start to sell the market off below the fairest price, they are getting what we call short in the hole. In other words, they're selling at prices below the fairest price for the day. Now, they're not always, sometimes they make money. They didn't today, they were multiple times. But when we talk about the patience, so there's two sets of patience. Did you have the ability not to get caught by shorting this market? You know, did you watch it go down? You know, could you stay out of shorting this market late and not being a laggard? Then did you have the patience to wait until you got right down to the lower end of the market before you made your buy? Sometimes if you don't have patience, you get too anxious. So the market's coming down here, it's just a little bit below the fairest price, and you can't wait, you're too anxious, so you buy right here. Well, then you buy, the market goes down, and you get stopped out. And you say, oh, I was right, but I got stopped out. No, you weren't right. You didn't have the patience. You didn't have the patience to wait for the right moment. And another thing you have to have here is a willingness to say, if the trade doesn't set up the way I want it, I'm not trading. That is very important. Sometimes people are too anxious. They're too afraid to miss a trade. You've got to get to the point where you are very willing to miss a trade, and that's the time when you start to turn the corner and be profitable. So patient, not to get over anxious and sell into this and get caught down here, but also patient and the willingness to go with this market knowing that it's probably gotten too short down here. Okay, I mean, there's a lot involved. There's a lot involved. Remember, the success ratio of people that trade is very small. Those that make it make a lot of money. And there's a lot involved. And it's not just the mechanics of the market. An awful lot has to do with you. You know, are you disciplined? Have you done your homework? Do you understand the market? Do you understand the behavior of those people that you are competing against? When you start to understand the behavior of those you are competing against, you have positioned yourself very nicely for a trader. Again, I put up another example of what we just talked about. This was Friday. We showed today, but also the same thing happened on Friday. There was the point of control. The market got too short, it rallied. It got too long, it broke. It rallied. It broke again late. Again, it was going around this point of control, or the fairest price at which business was being conducted. It took a tremendous amount of patience, but the opportunities were there. Now, the other thing you'll find, we'll talk about this again later, this was the point of control is a very important part of what we do. Sometimes it migrates. When it migrates up or down, that tells us something. It doesn't migrate, that tells us something. But it is a reference that we use, that it's a dynamic reference because it develops as the day is trading. It's not based on mathematics. It's not some magical number. It is a real number based upon the trading that is taking place in the market. This is the fairest price at which business is being conducted. And if you can think of it that way, it is easier to imagine what happens when the market gets down here. Could they be too short? Could they be selling in the hole or selling at prices below fair value? What about it gets up here? Could they be buying at prices that are above fair value? And the answer is absolutely yes. Self-assessment. This is extremely important. First of all, what is your time frame? I said earlier that the majority of our clients are day time frame traders. And it's okay, if you're a day time frame trader, then make sure that you recognize you are a day time frame trader. And that, what you don't do, if you've got a loss, all of a sudden you're a day time frame trader with a profit, but all of a sudden you got a loss, now you extend the time frame because you're not going to take the loss. So you take that home. Well, that's not a day time frame trader. You've got to determine what your time frame is, and you've got to be true to it. You know, and if you're a shorter term trader, meaning a shorter term trader takes trades longer than a single day, that's all right. Knowing that, then you say, I am a shorter term trader. I am looking for opportunities that are over and above that of the day time frame. Okay, that defines the kind of trades you're looking for. But if you're a day time frame trader, don't lie to yourself and tell yourself that, you know, well, today I'm going to take it home because I don't want to take the loss. If you're a longer than a day time frame trader, let's say you're a short-term trader, you'll take positions for 2, 3, 4 days. That doesn't mean if all of a sudden you get a profit and the auction's not completed, well, you take that profit. You take that profit today, not really because the trade was over, but because you couldn't resist taking the profit. That has to do a lot with what is your time frame, and stay within that time frame. Next, how much and how do you prepare? Do you develop at least 3 potential scenarios for the following trading session? We talk about this constantly, and a lot of people talk about it. The number of people that actually do it is extremely limited. The reason for doing 3 scenarios is, 1, so you're prepared and you don't have to make all these decisions on the fly. And that's very important because when the markets are really moving, it's very hard. It's very hard unless you are prepared to be able to make that decision. For example, the reports we wrote coming into today talked about the 2-day balance. 2-day balance was identified by Friday's low, and the 3 scenarios we had, well, if we got to that low, were 1, not take out Friday's low, 2, take Friday's low out and be rejected back into Friday's range, or 3, take that low out and accelerate lower. Well, guess what? We took that low out and we accelerated substantially lower. If you've thought about that ahead of time, and you watch the market going down, it's a lot easier to pull that trigger than it is if you haven't thought about it and you haven't prepared those different scenarios. Now, here's the biggie. Here I think is probably the biggest one that we're going to deal with. Everything we've talked about is important. But right now, what tools or indicators do you use to make your trading decisions? Looking at them one at a time, do they really offer value? We got an email over the weekend from one of our traders, one of our subscribers.
Yeah, and Jim, that's in the report, and I did let everyone have the reports, just so you're aware as you're talking about Mondays, the morning and the after, prep report. Thanks.
Thank you. What is significant is it's entitled my first profitable week ever. Not only that, that wouldn't have caught my attention, just that it was a profitable week ever. But what caught my attention is this trader was profitable all 5 days of the week. It was a very volatile week last week. But really what was inside, what he talked about, he traded value. He traded on value, and he looked at market-generated information. So what is behind in that? What is within that? What didn't he trade? He didn't have a screen that was set up with numerous bid offers or whatever you look at, very short-term tick indicators, very short-term trend lines, and all of the things that so many people have out there. If there's a consistent theme that we are hearing from people that have gone from unprofitable trading to profitable trading, it is that they have cleaned all of this off of their machines. And without taking away, and I get people to tell me, well, we have one really good client, he said, well, Jim, I understand what you're saying, but I'm going to keep my 5-minute bar chart on there, or my 5-minute bar on there, because it really helps me with my entry and exits. And at the time I said, well, I think what's going to happen, it's going to keep, once you look at these really short-term indicators, you are so mesmerized by price, you are so short-term oriented. I mean, we're talking about, you know, within seconds and minutes. You couldn't anymore see the big picture in the market. The only way, if you are not profitable and you're looking at these one at a time and you ask yourself, is that indicator that you're using really providing value? Are you truly profitable as a trader? If you're not profitable, then what you've been doing isn't working for you. Now, you're going to be hooked at those when you've got those indicators on there, and you got lines that cross, and you got bid offer, and you can watch and see, you know, oh, look at this bid, look at this offer. You'll kid yourself to think that that's really important. And maybe it is. If you're profitable and you're meaningfully profitable, fine. Go ahead and do what you've been doing. If you're not profitable, get it off of there and start listening to how we look at the markets. I showed you a couple examples earlier looking at the market profile. The market profile doesn't tell you to buy or sell, but the profile organizes the data. And if you can see the organized data, just examples, we can see the fairest price at which business is being done today. We have a substantial advantage over everyone else. But I go back and I'll stay on this. These tools are indicators. If they don't make sense, you get them off your machine. Don't lie to yourself and say, well, I'm not going to use it. I'm going to use the market profile. I'm just going to leave them there. It's like going on a diet and leaving 3 eclairs, you know, in the front shelf when you go by the fridge. Now, what are you going to do? You think you're going to go on a diet and have 3 eclairs in the fridge and not think about them? It's not going to happen. Oh, this is a personal decision you have to make. And again, it ties in with the last one. The mindset of a subscriber to the intensive should be an open mind and a willingness to change and become a better trader. And that's easy to say. It is easy to say. Making the transition is extremely difficult. When I look at the potential personal goal, take a note of this, the potential personal goal of anybody that is in the intensive program should be to gain control over their trading decisions. For example, you know, if you're in control of your trading decisions, you're coming out under your own power. It's going to be a rare occasion that the stop takes you out. It's hard sometimes, but you know, you stay in touch with the market, you put the stop in. The stop is a fail-safe measure, but 95% of the time, you ought to be coming out of that market. You ought to be coming out of that market based upon your trading decision, not based upon the stops. I had a very good day today, a lot of short-term trades. I had stops on every trade. I did not get stopped out once. I came out of all of those trades under my own power. That gives you confidence too. When you do that, it's a tremendous It's tremendous confidence building. And building confidence has an awful lot to do with successful trading. So the personal goal is to gain control over your trading decisions. Next, over your environment. Now, what do I mean by over your environment? I'm going right back to what tools or indicators do you use to make your trading decisions. You have control if you're going to have all of those bid offers and all of those tick indicators and very short-term trend lines on your machine. That's part of your environment. You have the ability to take and clean up that environment. So your potential goal is to control your own trading decisions, have your environment that you want and one that you have truly decided that it's the right environment for you, and then be able to control your own behavior. So there's a little difference between trading decisions and behavior. For example, a trading decision might have been like this afternoon when I showed, when I thought the market was getting short in the hole, and we put the post out, it's time stamped and everything else. Well, your behavior, could you control yourself not to step in too early? And when the market got down near the lower extreme, could you then pull the trigger? Did your behavior allow you to not get long too early and to be able to pull the trigger and go long closer to the low of the day? Now, that's not easy. That's behavior is easy to talk about. But when you've got a trading environment, not a trending environment, but when you've got a trading environment, when meaning the market is rotational, okay? At that point in time, your best trades are going to fly in the face of the most recent market activity. Those are not particularly easy trades to do. You've just seen the market going lower this afternoon, and yet, the correct decision is to be a buyer, okay? So I'm talking about potential goal is have control over your trading decisions, control over your environment, and control over your behavior. Trading decisions, environment, and behavior. That's, I think, really you package that up and you start to say, what kind of progress am I making? And that will be a great beginning towards becoming a profitable trader on a consistent basis. Self-assessment. Some of these we talked about a little bit earlier, but how do you use stops? How often do stops take you out of a trade? A lot of times, you've got to go back and really make a concrete assessment of how you are using stops. The majority of traders place stops that are too close. They lie to themselves, not intentionally, but by having a tight stop, they think they're being prudent and actually controlling risk. And the truth of the matter is that they're not. They're probably increasing risk. By having stops too tight, you have taken the odds up very high that you will, in fact, get stopped out. And markets need a little bit of room. They need a little bit of room. Look at the volatility that we've had in these markets. You can't have overly tight stops on you. Your stops should be placed someplace close to some structural level. Maybe it's where the market takes stops one time framing, or maybe it's just a little bit short of the high or the low for the day, or up near the point of control. But it ought to be something based on structure. When we go on Wednesday, as we start to go through actual trades, and what do you do on a regular basis, we'll be more specific. But think about, as part of the self-assessment, before you get into the intensive, go back and do a really solid review of how you are using stops. You shouldn't be being taken out of your trade more than about 5% of the time. The majority of times you should come out under your own power. If stops are taking you out too often, it's either because you really have bad trade location to begin with, or your stop is just too tight. And being tight, like I say, it does not afford you the protection that you think it does. it may afford you that protection on that trade. But when you add up a cumulative number of trades that you got stopped out of, you will find that those nickels and dimes and the spreads between the bid and offer become very, very expensive. Okay? How many of your trades are in impulse? For example, fading a trend day. Last week, as you remember from the intensive, last Thursday, the market gapped higher and at one time frame higher for the first 4 periods. One of the chats that I put out, well, I don't remember the exact wording of it, but the chat was trying to say, do not fade this market until at least the market begins to show you two-sided trade. What is two-sided trade? One time framing is where the first bar, if its market's going up, the first bar closes. The second bar does not take out the low of the first bar. It does take out the high of the first bar. The third bar does not take out the low of the second bar. It may not take out the high, but it doesn't take out the low. It's still one time framing higher. Markets, and you've seen these on chat comments, markets are always looking for a place where two-sided trade can take place. That's what any business is about. Let me go back for just a second, and I'm going to, one more time, show today's profile. We had this huge break in the A period this morning with a little extension in B period. And then what did the market do for the rest of the day? It settled, right, it traded back and forth between the 23.50 level or 23.25 level. The market found a place where two-sided trade can take place. This is the purpose of any business. Any business wants to be able to have both buyers and sellers. They want to have an active business with active participation. And that's what markets do. We saw this last Thursday, big move up early in the morning. The market found a place where two-sided trade could take place. We saw this same thing take place on Friday. There's an early break on Friday. And guess what? The market found a place where two-sided trade can take place. It is amazing. You don't fade the trend day. Let me go back to last Thursday for a second. I'm going to split this out. Okay, here's last Thursday. The market gaps higher, big gap higher. High confidence from the opening. This is a go-with situation. You know, some people get scared. Oh, my golly, I can't do this. The market's up 17 handles. Confidence is high. It's a go-with situation. A period, B period, C period, D period. And what I wrote up there, I said, do not look at fading this market until at least you have a level where two-sided trade can take place. Look what happened. Finally, we got C, D, E. We quit one time framing higher. Guess what happened from here on out? We had two-sided trade. Was it perfect? No, it wasn't perfect, but it was a whole different environment. And it's again, it takes maturity. And we were talking before about, can you control your behavior? How many people that are on this meeting right now couldn't resist fading this market as it went up in A, B, C, D periods? Oh my golly, this is too high, it's got to come back. It was up 16, 17 handles overnight, it's up another 16, oh, it's got to come back. I've got to fade this market. How many people faded that market only to get stopped out? It's very rare that once you get that kind of momentum that the market's going to give much back. But ask yourself, did you control your behavior? Did you wait for the market? Did you wait patiently for the market to develop two-sided trade before you wanted to do any fading? Or could you not resist this move up? So it's up 25 handles. It's got to be a good short. And you get stopped out. And then you probably get mad and do it again. So there's a tremendous amount of disciplines, patience, and behavior modification that is required to be a successful trader. I took a quote from how many of your trades are on impulse? For example, fading a trend day would be one. Okay, this is a Van Gogh quote I saw in a book. Great things are not done by impulse, but by a series of small things brought together. That is just That is just a huge, huge consideration out there. This is where you earn your keep. And what are we talking about when we say by a series of small steps, brought together? We do our homework, we look at overnight inventory, we look at where value is developing today, and we'll do this much more specifically on Wednesday. But you want to see, where did the market open? Did we open in balance or out of balance? How much confidence is around the opening? Is value going to be higher or lower? Those are the kind of step-by-step things that go into making your decision. Trading is about managing your own expectations. You can control risk, however, you cannot control the profit. When a market is going up, for example, and you can control how much risk you're willing to take, but you can't control how far the market's going. So it becomes very key to control risk by identifying trade location. Okay, for example, you say, we saw last Thursday, this big day to the upside. How would we control that risk? Well, once it opens, you don't want it to come back. You had a gap. You don't want it to come back into that gap. Once you got an open and drive, you want it to go and keep going. You control that. You want to trade value. You want to see that value is moving higher. Value is where 2/3 of today's trade takes place. The biggest hindrance to most people's successful trading is that they can't get away from trading price. Price is nothing more than an advertising mechanism. It is so misleading, you cannot believe. The difference between price and value. Price will move faster, value will follow. But value is what you really want to trade. If you're trading against value, use both a structural stop and you can use a time stop. For example, if a market's going up, for example, when it was going up crazy last Thursday, or down today, and all of a sudden you're short, but you don't really know where to put that stop because it's just creating like crazy. If the market starts to slow down and it's hesitating on the lower end, you can use a time stop, and you can say that it's just been too long at this level trying to go lower, and it's not successful in what it's trying to do. That a time stop is very valuable. When the markets are going crazy and you don't have anything else to go on because there's just too much stretched out too far. Again, we talked about going the step at a time. Let's prepare for a day by looking at all the small things. Okay, and here's kind of a collection. We're not going to do this today. We're going to do this on Wednesday. Today, and we're going to talk about this a little more right now. But what I wanted to do today, I wanted to really talk about the personal side, the self-assessment, your behavior, the trading environment. Trading environment being, what do you have set up on your machine? Those important type of things. How do you use stops? I think you will find that the things we've talked about early today are as important or even more important than actual looking at the market and actually looking at profiles in front of you. A lot of times people say, oh, I don't need all that other stuff, Jim. I just want to go to the profile and show me what I should have done today. And let me do away with all that other stuff. That's too ambiguous. I don't understand all that. I just want to go to the profile. Once you get that attitude, you have very little chance of being successful in the market, because those self-understanding, the self-assessment, who you really are, your environment, those are far more important, or at least equally as important, as what the market is doing right in front of you. Okay, when we prepare for a day, we look at all the small things. I start off, I look at a monthly bar chart. I look at a weekly bar chart. I look at the daily bars. First of all, I want to see, what is the monthly bar? If I looked at a monthly bar right now, it's very quick. It tells me that the market is at we're just shortly under the all-time high. The long-term auction's still up. The weekly bars are showing a little bit more balance. the daily bar, we have a short-term auction to the downside. Okay, so when I look at that, I say, okay, very quick, I get a perspective. But these will reflect roughly the long-term, intermediate-term, and short-term time frames. So my perspective, when I get into today and I look at the monthly, I disregard the monthly fairly quickly. And because I know that the long-term auction has remained up. I know we're getting a lot of volatility in here, tremendous volatility last week. But the market certainly hasn't made a clear decision one way or the other. So I'll look at the weekly, and then I go very tight to the daily bars. Then I come down on what I see on the daily bars. If you looked at the report, and Julia said she sent it to you, my focus was on a 2-day balance. What I wrote over the weekend, that I was neutral. I could make a case for the market going up to the all-time highs. I could make another case that the low last week was not a good low because it didn't sufficiently test the trading range that we had re-entered. But so I was neutral. I could go either way. But I had a 2-day balance. And what did we do today? We broke to the downside below the 2-day balance. So I was prepared, and the charts kind of helped me with that. And determine the trending or balancing for each. The 2-day we were balancing. You know, but again, you can go through those things when there's no pressure on. The markets are not open. The markets are not open. That's when you do your homework. That's when you do your preparation. That's when you get ready for the following day. You know, and here, long-term, intermediate-term, short-term, we'll talk about these more specifically. But are we balancing? Are we trending? And it gives you a perspective. Auctions and time frame. The market distributes its bids and offers via a continuous two-way auction process. The market profile records these auctions in real time. The profile gives the market, here's extremely important comment, visual structure. Visual structure. Let me go back one more time, see if we can overwork this, to today's market. What was I looking at today? Once the market broke, late in the afternoon, I had a very visual market. That is just a godsend. It takes out a lot of the emotions from the market. What happened before, when a lot of the trading used to take place on the floor of exchanges? Short-term trading was seen, the floor had an advantage, and they had an advantage because they could hear the noise. For example, when the market got up to this level where we made the high in D period, let me make that a little bit bigger. If you were on the floor years ago, when the market got up and made this high, what do you think happened to the noise level? Traders on the floor, they traded by noise. So when the market got up to this level, the noise level got light. It went up there. When the palms are towards you, you're bidding for the market. When you were on the floor years ago, if the palms are facing you, you got your hands up in the air, you're bidding for the market. When you get to that high, which was exactly at halfway back, what did I say earlier? Halfway back is a day time frame trader's reference. Short and day time frame trader's reference. When we failed there, that told me a lot. That told me that my selling from there on out was probably going to be by the day and short-term time frames. It wasn't the longer time frame, and was a good chance I would come back towards that level. But from a noise standpoint, when it got here, the market would have gotten very quiet today. If, in fact, the market was going to take this out and go higher, the noise level would have picked up here. Now, we don't have that. The floors don't do much of the trading anymore. It's electronic. So what substitutes for the noise level that short-term traders used to have on the floor? What substitutes for it now is visual. We can visually see the two-way auction process is captured via the market profile. We can see the short-term references. We can see the fairest price at which business is conducted. We can see the rotation. Tremendous advantage over sound. Okay, let's go back. And so that's it's a very visual undertaking. The profile, if used correctly, will replace almost all of those short-term indicators, price-based indicators that so many traders have on their machines right now. Again, I say we are seeing a pattern of people that are reporting success where they've never had success in the past, that they are giving up those indicators, they're coming over, and they're relying more on the market profile. Now, I mean, that's really what what we do in the intensive. We just keep coming back to that the whole time. The value of the profile, the value we try in the intensive, we try and help you understand markets from the point of view of the behavior of those you are competing against, understanding your own behavior and what a part that plays, and then using the market profile to show you the structure of the market so you can visually see right in front of you what is going on in the market. In order to see that, you can't, if you get following price too closely, you're not going to see that structure. You're going to, afterwards, you say, oh my golly, how did I miss that trade today? You missed it because you were too tightly focused on just price alone. Okay, again, we won't do this. We've been this before. We've talked about structure. We've gone back to it several times. But again, this is just the one example we had in there that shows you what goes on. Here's another example that happened. This was what Friday looked like. Same thing we had today. About 85% of the days are trading days. About 15% of the days are trend days. So about 85% of the time, we're going to be looking at trading opportunities. About 15% of the time, we're looking at trend days. But even on trend days can go and they can start out as a trend day and then they can morph into a trading day, or sometimes you'll have it starts out as a trading day and then it morphs into a trend day. So those things do happen in there. But you know, you'll see it, you'll learn through the intensive to understand when that is likely to take place. I don't know how we got there. The larger, the wider the point of control is, the closest, the longest line from reading from left to center, which is also the fairest value, the wider that is, the lower the odds that we will evolve into a trend day. Positioning yourself for the day time frame, very quickly, and we'll do this in detail on Wednesday. We look at the overnight inventory. Is it long, short, or neutral? We know that about 65% of the time there's a counter auction to overnight inventory. Overnight inventory coming into today was long. And one of the things I wrote in the morning report, the odds favored a counter auction to overnight inventory. My guess is today's break was accentuated by the overnight inventory that had been long. Okay, you know, opening, do we open in or out of balance? Today was unusual. We opened in balance, but we quickly traded out of balance. Very important. You know, position yourself for the time frame. We look at market references. We look at where values developing, and we're looking at ruling reason. Today, I wrote in the report that the crude oil was making new all-time highs prior to the opening. Now, I hate markets that are trading off of something like crude oil, but we're realists. That's what the market's doing. And I thought this morning the ruling reason more than likely was going to be crude oil. Whether that's a legitimate reason or not, my guess is that the long-term money is saying, hey, they like that down. They think that's going to help us. They think lower oil's probably going to help us over the long run. Short-term traders, oh my golly, they see the end of the world coming because of this. But the ruling reason today, we live in the real world, was they're probably going to focus on crude, so that's why it was covered in the report. I'm looking at one of my other screens, and we have new lows in the after electronic market in crude right now. So again, short-term reference are important, depends on whom you're competing with. We'll look at the opening, unchanged, overnight high and low, previous high and low, dynamic references that develop, half-back, high-volume nodes, value. We're going to go these are generally very important references for you to monitor what's happening once a day opens. Okay, I've talked for a long time just going through what I think are some extremely important considerations for those of you that start the intensive a little over a week from now. in a couple of days. If there's other people on here that would like to join us for the intensive, you may not have the background. There are some different videos that are recorded that will help bring you up to speed. This is recorded, and we're still welcoming participation. It's a good class this time, but let me stop at this point. And Julia, let's open it up for about 15 minutes of questions.
Okay, great, Jim. Thank you very much.
I'm assuming somebody has a question.
Yes, we have several. Right here, quick, you were talking about halfback today, how it rallied. If you could show that on your profile. Question coming in, would a reasonable stop be 7 to 8 ticks above the halfback level, or is that too tight? So if you could just speak to him about what you're thinking when you're looking to possibly fade halfback in that D period swing up.
Okay. So let me take your question contextually. The first time it goes up and you want to short, I think that first of all, before you want it to short, you want to see the tempo getting very slow here. You should be focused on halfback. You should be focused on halfback because that is a traditional day time frame or short-term trader's reference. You want to see the market, the tempo slowing down here. So once it slows down here, it is a legitimate short, and now having a stop 6 or 7 ticks above that is perfect. It may not even have to be quite that high. What you don't want to have happen is once E period opens, and this we're always talking about, you put a trade on, and then you monitor the trade for continuation. So if you put this trade on this morning, and the tempo's gotten slow as it looked above halfback, which it did, what you don't want to see is you don't want to see E and F period come up and start to find acceptance above halfback, because then you're probably going to start to get upward extension. So how do you monitor for continuation? Initially, you do your short, you put your stock 6 or 7 ticks above this, but then if all of a sudden you start getting accepted here above the halfback level, change your stop to market and come out of the trade. Don't wait until you get stopped out. Now we're talking about patience. When you get patience in here, E, F, G, you didn't get much reward. It kept coming back up here, kept scaring the daylights out of you. And there was a lot of volatility. I mean, E, F, G, a lot of volatility here. But if you're staying with the trade, your stop is good. And what you want to see is the wider it gets here, the lower the odds that you're going to be able to take the high, the lower the odds you're going to be able to take the low. So that the stop, it would have been a great place for a stop. What led up to the stop or the short would be a halfback. You know that reference, and you didn't get accepted above that, so you know where to put the stop. It's a good idea. May not even have to be that wide, and then you monitor for continuation. You don't want to see acceptance back above halfback. Great question. Thank you. Julia, you got another one?
Yes, thank you, Jim. Would Jim consider today's low as a poor low with just 2 ticks, but also contextually looking at the profile, how fat it is at the bottom? Would you consider that a secure low?
It technically qualifies as a good low because it's 2 ticks. Your question's an excellent question. No, I wouldn't consider it a particularly secure low. Because when you come down this late in the day and you get buyers down here, okay, is that new money buying? New money buying does not wait until you're 2 ticks below the low in order to buy the market. That were people that were short or short-term traders. My guess is they were just people that got too short, too excited about this, market breaking again and crude oil going down, because crude oil was making new lows in the electronic market. I think this was a knee-jerk reaction down, but that's not a particularly healthy low. No. Okay, good question.
Not necessarily completion to the downside.
Correct. Okay. I'm going to spend more time tomorrow. I'm going to spend more time focusing on how fat it is up in the center of today's range. The fatter or the wider it is, reading from left to right, the more prominent it is, the more likely we are to need to revisit that tomorrow. Does it have to happen? No. But so I will look at that in conjunction with the low, but I also put out a post this afternoon. Just remember, I'm always looking at all the contingencies. I put out a post this afternoon that said I thought before this week was over that we would come back and take out this D period high. And the reason I said that was that the selling that takes place just 2 ticks above half back, it tells me that that's not longer term selling. And what I'm looking for, and this is why I put it in the chat comment that I thought later this week we would come back, is because this is such a mechanical place for sellers at exactly half back. So that was not longer term money selling there. That was day and short term traders. That doesn't mean that the tone for the day isn't down and they don't control that tone for the day, but I'm certainly going to, and we have a term that we use intensely called carrying information forward. And I think I put in the chat, this is information or a reference level that I am going to carry forward, because I'm not going to be a bit surprised if we don't see that taken out. And particularly when I look at how many single prints there are up here and how fat this market got down below, if I had longer term selling that said, hey, good chance the market's going lower, I'm not going to get this fatness. I'm going to get elongation to the downside. So more than likely, we've got a lot of people caught short. Doesn't mean we don't go down for a couple more days. But I'm very cautious that this high, midday high, was made by day and short-term traders rather than longer term. Okay. Now you combine that. So one point I can argue that I don't think this high is any good. And then we just answered the last question. Do I think this is a tremendously secure low? No. So would I be terribly surprised to see the market trade both sides of this tomorrow or during the week? Not at all. So this is part of the thing that when we're talking about the meticulous preparation, it's being able to objectively look at the market and say, ooh, I don't particularly care for the D period high today. I don't particularly care for the low today. We're very fat in the center. So I'm open. Neither taking out either one of those would not be a tremendous surprise to me. The worst thing that happens is a trader that has only one idea in mind. For example, I don't like this market. I know this market's going down. They're really going to kill this market. Hey, sometimes you're going to be right. But somebody with only one idea is usually not going to make it over a longer period of time. This is why I love to develop multiple scenarios, so I'm prepared. Okay, a couple additional questions.
Great, thank you, Jim. When you're looking for trade location, what makes you pull the trigger when you're at a good location? You cannot, buy a falling knife, for example. So what are you looking at to gauge and confirm rejection?
Okay, one, and I'll tell you what I did today. I'm looking at how fat this is up here, and as this market got down in this area.
What period, Jim? Excuse me, sir.
Oh, and I don't remember exactly, but in the HIJ
okay,
period,
but more toward the afternoon. Okay.
Yeah, and sometimes I will lean into the wind. I don't have to have an excess low. I will lean into the wind, and I did lean into the wind. I'll give you a chuckle. I bought 2 or 3 of these earlier today. I did not buy this one, and of course this was the best rebound there was. And I'm like, oh, I can't do it a third time. And I think I put a chat out that said it's silly to trade in here, and of course that was the best bounce off of it. But sometimes I'll lean into the wind because my confidence is that this is fairly wide. It's very wide up here, and the chances of taking this low are fairly slim. J period came down just a few ticks short of it, and it didn't take it. I had stops down here at the 2014 level, just slightly below this. Obviously, I didn't need them. But so sometimes I'll lean into the wind based upon this structure. Let's go back and look at Friday. We got an email over the weekend from a a trader that's been with us for some time, and he asked me. Well, first of all, the email said he had his. I think it said he had his best day ever, but I got an email late in the afternoon just said, "Is this the 45-degree line?" The 45-degree line, and incidentally, that's what this would be. When you can draw a 45-degree line from the point of control down to the low, that's what we call a 45-degree line. That's usually an indication the market's getting too short. He asked me if this looked like a 45-degree line, and I said, I emailed back and I said, it looks like a 45-degree line from the low to the high. So it looked like they were just taking inventory, getting too long or too short. The market rallied all the way back up here in L period and then comes down and settles down here. So it turned out that 45-degree line, it was good to the short side, and I'm sure he did this trade. I don't know if he did this one, but I know he did this because this is where he asked me.
Yeah.
And bought it down here. You know, it's a good odds trade because of the fatness here. So anyhow, but sometimes I don't wait. You know, if it's this falling knife thing. Falling knife is a term that's more applicable on a trend day. It's not the same applicability on a rotational day. On a trend day, I will never lean into the wind. I'd like to say I never would. I did confess to Julia that one time last week I caught the falling knife, and she asked me the next day of how my hands were, and I said I'm picking things up with my elbows. So I'd like to tell you that I don't make mistakes, but I do. But so I did it by mistake one time last week, and but today, on days like this, it's very common for me to lean into the wind and and fade the break before the actual low, simply because I have high confidence. Okay, we've got time for 2 more questions.
Okay, sir. I seem to have a good routine and pre-market outline potential hypothesis for the day, up, down, and sideways. I usually get narrative correct and get into good setups early, but as the day progresses, I have a tendency to get caught up in chop and place lower probability trades that result in stops or not good follow-through. How can I avoid the tendency to trade and chop and define this early in order to stay away from it in a two-way?
My guess is you've got too many price, and you tell me if you've got time to come back to Julie. My guess is you've got too many price indicators on your machine, and I'd be willing to bet that you're looking at bid-ask offers. Tell me if that's right.
Okay, well, we'll wait for him to come back.
Okay.
I had asked him, are you using 2-minute and 1-minute tick charts? Because it gets very disorienting. Or at least train your eye to go back and look at your 30 and 60-minute if you look at those in the bar charts, because it's so easy to lose perspective.
Once you put the shorter stuff on your machine, it's almost impossible to keep the larger perspective. Okay, I'm going to take a final question. Julie and I both have places that we have to be, so let's take a final question.
If you're not trading futures, can you apply these principles to the SPY?
Absolutely. Absolutely. Matter of
SPY
fact,
actually mirrors it well. We were looking at it.
Yeah. I don't know what it looked like today, but it's used very similar. And I use it. I trade the double short for my retirement account. I trade the I think it's SDS, which is double short S&P, and SSO, which is double long the S&Ps. A lot of times I will trade that in my retirement accounts based upon what I'm seeing here on this market. Before we wind this up, did we get an answer back from the person that asked about the getting chopped up?
No indicators, but VWAP and midpoint.
Oh, okay. Okay. All right. So, like I say, Julie and I both have to be someplace this evening. But
in terms of his issue with chop, I mean, I know that once we start looking at the profile and we can see that it's widening out, and really just you can see how wide the TPOs go, it does help. First, Jim wrote many reports last week or a few, that they said, two-sided trade. That was your first clue that two-sided trade may be developing. When we went 3 wide on the profile on Friday after careening down, E-period came back up, and we finally went 3 wide, and Jim had chatted. This may be where we're going to start finding two-sided trade. So it's to be thinking about it too, right, Jim? I mean, to anticipate that what may be coming and not to get too caught up in a move, a wide price excursion in either way.
What is more important is this willingness to forego a trade. Too many people are too anxious and they want to, if they're kind of addicted to trading. And it's having the patience to say, if I don't get the trade I want, then I'm not trading. When this market was coming down today, I mean, I could feel it. I could feel it stumbling. I was leaning in. I was, should I buy it early? I waited, but I felt it. I felt, oh my golly, I don't want to be. I think it go all the way back here. I don't want to be too late. I felt it, and we can do a lot of things to ourselves. It's the patience to say, if I don't get my trade, I'm not trading, and if I don't trade, the world's not coming to an end. Anyhow, hopefully there's when we get into Wednesday, we're going to be much more specific on developing value and entering trades, and being more specific about how do you actually work. So in the preparation for when we get into the intensive, we're going to talk more about some of the logical questions we hear all the time. What's a poor low? What is acceptance? What is rejection? We'll address those on Friday in order to get people prepared for the intensive. But if you're not signed up, the intensive starts next week. It goes for about 5 weeks. It's the idea is, it was Julia's in the first place, that one of the things about trading, it's one thing to look at things, it's another thing to be able to internalize the information. And what we realized after listening to Julia was that you've got a much better chance to see a multiple types of markets over a 4 or 5 week period. You have a much better opportunity to internalize some of the important information than just briefly seeing in a 2 or 3 day program. So it's a serious program. There's a report, a recap and preparation report at the end of each day. There's an update in the morning that covers overnight inventory and any change we saw take place. Like this morning, the change I mentioned in the morning report was that crude oil was making new lows. Just trying to keep people in touch with what may be going on in the market. There's a one-way chat function that I chat throughout put posts out throughout the day. Sometimes I'm right, sometimes I'm wrong, but it's to keep you oriented to what's going on in the in the market. And then we have the chat, and then we have about 8.5 to 9 hours of live seminar a week. So we're on almost every day. We're not on every day, but we're at least on 4 or 5 days a week, where we're on for an hour and a half, sometimes up to 3 hours of just negotiating the markets along with you. So you get a more real hands-on feeling.
And
so
sometimes we're on twice a day, or we'll have a bookend session.
We call bookend sessions.
Yeah.
Let me say thank you very much, Julia. Good luck and drive safely, and I will do the same.
Okay.
Once again, thank you all very much.
Okay, and thank you very much, Jim. That was great. A lot of information. We appreciate it. And thank you, everyone, for being here. It's fabulous to have you all, and you all stayed on, hang in. So if you want to review this or send the recording to a friend, it'll be up later tonight. I got a jet, so I can't load it until a little later, but it will be there. Okay, and everyone have a nice evening or whatever time of day it is for you. Enjoy your day. Okay, thank you. Bye-bye.